I am Graham Cook, the head of consumer research at Finder. Welcome to another Finder Insights video. In this video, we are going to take a look at the crazy last 24 months of the property market in Australia, and following today's RBA cash rate hold, what could be in store for the next 24. But before we start, let me show you this chart. This is a chart of the owner-occupier borrowing for housing in Australia over the last 3 years. And as you can see, it remained fairly consistent for 2019 and 2019, but halfway through 2020, despite lockdowns, despite economic uncertainty, despite COVID-19 causing havoc in economies around the world, borrowing for houses went up and to the right and took off spectacularly. Why did this happen? We'll get into it in this video. So first we're going to talk about 2019, which was a bit of a hiccup year for house prices in Australia. Before we do that, we need to decide a number we're going to use to measure the change in house prices in Australia over the course of the times we're talking about. That represents something nationally. Now, 70% of Australians live in capital cities. And what we're going to do here is look at the average of the 3-month rolling house price and apartment price in every capital city in Australia with more than 1 million residents. That means we're going to be looking at Sydney, Melbourne, Brisbane, Perth and Adelaide. So these numbers are the average of all apartments and houses in those cities, so 10 data points in total. So this chart shows the property prices across 2018 and 2019 based on that national average figure I talked about. And as you can see, the property price figure was pretty steady through 2018. It bounced around a little bit, but then property prices experienced a very significant drop towards the beginning of 2019 in January, February, there towards the middle of that chart, stayed low for several months and then increased in October and November. So we had a price dip and then we had a price recovery. So why is that? Well, basically the reason is the cash rate. Now the cash rate is the rates that the Reserve Bank sets for local banks, which determines the cost to them of borrowing money. If it costs them more, your home loan interest rate goes up. If it costs them less, your home loan interest rate goes down. This also affects your savings. So when the housing market is struggling, when the economy is struggling, the RBA can cut the cash rate, which makes it cheaper to borrow, which can stimulate the market. And if we look at this next chart, which is the same chart as before, but with the RBA cash rate superimposed across the house prices, you can see that as the house prices dropped, RBA dropped the cash rate. As they continued to drop it, the house prices started to rise. So what drove the increase in house prices towards the end of 2019 was cheaper borrowing as instilled by the Reserve Bank of Australia. So it looked like the housing market was taking a turn for the better towards the end of 2019. So before we get to 2020, a little aside. I am Irish. I've been living in Australia for 11 years, but I was in Ireland around 2007 when the global financial crisis happened, when defaulted low quality loans in America started falling apart, which caused ricochets in financial markets around the world and caused many housing bubbles to burst, including the housing bubble in Ireland. The effects were quite dramatic, and as you'll see in this chart here, the results we are still feeling here. This is the index of property prices in Ireland pre-2007. You can see it reached a peak and then dropped off pretty dramatically all the way to a low in 2013, where Irish property prices reduced by about 50% and then started to recover. But as you can see here, they still have not recovered to where they were before 2007. So house prices in Ireland are still lower than they were before the GFC. So you don't necessarily want prices continuously going up. You do not want a bubble. We will talk about the potential for a bubble in the Australian property market later in this video. So rolling on to 2020, the year of COVID-19, and looking at house prices across that year. The recovery that we saw in late 2019 continued for a little bit in 2020. I remember being, in this job at the time, doing some media commentary. We do surveys of both economists and the public in Finder regularly. We were hearing people saying they felt they'd missed out on the low price buying window that price dip in 2019 had offered up. We heard people who'd been saving deposits and who felt like they'd just missed out. FOMO slowly started to kick in, which is what I think started driving prices early in 2020. But then we start to see prices drop again as COVID-19 started wreaking its havoc on the financial markets, as lockdowns started spreading in various different levels of intensity through the States and Australia. This started to affect house prices, and we start to see house prices go down again. And in response, the RBA started cutting the cash rate again. Governments started putting together incentives for first-time buyers and owner-occupiers to start borrowing, and this made it even cheaper than ever to get on the housing ladder. Once it became became clear that the Australian government was going to do a better job of controlling COVID-19 than governments in other countries, people started to get more confidence in the economy and started investing in the housing market, which is why you can see in this chart that up and to the right, the housing market started to recover towards the end of 2020. Now we only have 11 months of data, so this ends in November, but you can see that the house prices are going up and to the right. In fact, in November 2020, the median house price in Sydney topped $1 million for the first time since 2017. I believe that's only happened for 4 months. So we saw two major dips, but now the market is recovering like nothing we've ever seen before. Let's take a look at the chart we looked at the beginning of this video. Now this is the amount of money owner-occupiers are borrowing in Australia to purchase homes, and as you can see, it remained relatively consistent through 2018 and 2019 and even the beginning of 2020, but then in the last few months has taken a leap into space. I was pretty surprised to see the amount of money that people borrow to purchase homes reach $16 billion in September this year. That's from a low of 11 during the month. And that was the highest we'd ever seen in any given calendar month up until that point. We do a lot of media commentary and find out around the RBA cash rate, and I was very surprised to see it hit $16 billion, but then it just kept going. Next month it was 16.5. In November we saw $18 billion borrowed, and in December a completely crazy $20 billion. To this date, the highest we've ever seen borrowed in one calendar month to purchase homes in Australia. So things are going in the right direction. If you own a home, things might be escaping you if you're looking to buy a home. Is it increasing too fast? We're going to cover that a little later. So 2021 and 2022, this is why you're here, potentially what's happening in the future. Well, in Finder, we survey 40 leading economists and property experts who work for large organizations and universities every single month. If you want to see a list of participants, you can check out the links in the video below. This month, we decided to ask them what they expect will happen to property prices across Australia by the end of 2022. And they told us they expect property prices to increase by, on average, 12% over the next 2 years. So what does that do to the chart? Well, this is what it looks like in that case. We see a 12% increase between now and the end of the year. We see the average property price increasing from somewhere between 580 and 600k to somewhere between 640 and 680. Now, obviously, nobody's expecting property prices to increase in this continuous linear way. This is just a forecast based on the growth that they were talking about, but this is the general idea of where they think property prices are now and where they might end up by the end of 2022. So let's try and put that rise in a little bit of context. Now, we asked a pretty simplified question of our panel. We just asked them what they think is going to happen to national property prices over this period. We could have asked specific questions in cities and specific questions about apartments and units, but we didn't want to make the question too complicated in this particular survey. So it's a general guide. But if we do apply this 12% to the current house prices in each capital city, this table shows where we expect prices to go. And it shows in Sydney, now that the average price is just over $1 million, that the average house in Sydney by the end of this will be worth 1.31, which means for the average household in Sydney, you're adding $120,000 to your net worth by the end of the next 2 years just by living in your home. Now, put that into some perspective, the median income in Australia is, believe it or not, $48,360. That's what the average Australian takes in every single year, whether they're employed or unemployed or depending on various different incomes they have. It means that the average person in Sydney is going to make 24% more than the average income in Australia just by living in their home over the next 2 years, which just shows why Australians are so keen to get on the property ladder and why property prices are increasing up and to the right so dramatically. But how much of an increase is too much? At what point do these price increases start indicating that we might be experiencing a bubble? We'll cover that now. But what about apartments? Well, we're not going to cover it in this video, but we did ask economists about apartments as well. And a certain percentage of economists, 70% in some cities, told us that they think apartments could potentially be a risky investment. For more information on that, check out the link to the corresponding insights blog below the video. So, is this a bubble? Is there potential for a bubble forming? We asked our panel this question as well. So they said 12% is what they expect property prices to increase by, but we also asked them how much of an increase would indicate to them that a potential bubble is forming in the housing market in Australia. And they told us on average 23%. So 23% increase or more than that could indicate to these economists that there is a potential for a bubble to be forming in Australia, and that might be time when it's, a good idea to consider your investment options more wisely and be a bit cautious of investing in the housing market. So there you have it, a 12% price increase predicted by a leading panel of economists. Following 2 years of pretty unpredictable price behavior in Australia. So will this actually be borne out? Will we see 12% price increase over the next 2 years? Is potentially a bubble forming already? Is 23% a good indicative level that a bubble might potentially be forming? Let us know your opinions. So if you're thinking about getting involved in the housing market, now may be the time to get serious with your plans. Though remember, the market can go up as well as down. Believe me, I've been through it. But we could be looking at a positive future for house prices in Australia going forward. If you want to follow more economic commentary and news, check out Finder's Insights blog, or you can reach out to me or follow me directly on Twitter at gcook with an E 42. Thank you.